Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Matt Schulz, chief credit analyst with LendingTree, to discuss consumer debt levels and how they're on the rise. Matt, it is great to have you in studio. Welcome to Trade Talks.
Thanks for having me.
All right, let's talk about these debt levels. How much have they climbed in the U.S. and how does that compare historically?
It grew about $52 billion in March alone, according to the latest Fed data. Most of that growth came in revolving credit, so mostly credit card debt. And that credit card debt portion went up the biggest percentage increase since 1998 and the second biggest going all the way back to 1984. So it's a big deal.
Why do you think we're getting hockey stick growth back in consumer debt?
There's a few reasons. One, banks are really eager to lend. They want people to spend. You also have that post-pandemic pent-up spending explosion that is certainly here. And then you also have to obviously factor in inflation, rising interest rates. It all adds up to a really volatile mix.
Why should consumers act now to get this under control, and what can they do about it?
Well, they need to act now because their debt's only going to get more expensive, because the Fed is only going to keep raising rates for as long as we can see going forward. So it really is important that people take steps. And one of the things that they can do that a lot of people don't think about is that they can call their credit card issuer and ask for a lower interest rate. About 70% of people who ask for that get their way. And the average reduction is about 7 percentage points, which is really significant, but very few people ask.
Are credit card issuers willing to lower rates and fees, or was this a pandemic-related trend?
It is definitely something that is still going on now. It was a pandemic thing where a lot of people reached out to banks asking for help, but before the pandemic, it was something you could do. Right now, as we're kind of emerging from it, you can still do it. You can ask for reductions of lower interest rates. You can ask for fees to be waived. You can ask for higher credit limits. If you don't ask, you're not going to get it. But if you do ask, there's a pretty good chance you'll get your way.
Well, I'm sure the credit card companies want to get paid back. It's better than charging it off, right?
Yeah, absolutely.
How do you think consumer debt is going to be impacted with rising interest rates? We know it's going to make the cost of borrowing more expensive, as you said. But it's also a higher inflation environment. I mean, it makes me wonder, are people going to have to start putting groceries and gas on their credit cards because they simply can't do it paycheck to paycheck?
Some people already are. Yeah. There's no question that consumer debt is going to grow because in part, that's just what it does. Aside from economic catastrophes like the pandemic and the Great Recession, we pretty much always have steady growth when it comes to credit cards. And right now, we're just kind of returning to the norm, and there's no reason to think that with rampant inflation, rising interest rates, and all the other factors, that there's no reason to think that credit card debt's going to do anything but continue to grow.
Right. It's interesting. It's almost like it's a cycle here. With the pandemic, obviously savings rates went up, right?
Sure.
People were getting stimulus checks or they just weren't spending on anything. Then you have this pent-up demand. Everybody wants to start spending money. Banks are willing to lend, and it just seems as if it's a vicious cycle that we have to kind of get out of this mindset and break from.
Yeah, it really is. And the best way to get out of that cycle of debt is to, when you are paying down that debt, to save a little bit of money back while you're paying down that debt. Because if you don't, once that credit card balance goes down to zero, if your savings are at zero, the next unexpected expense is just going to go right back on the card and the wheel keeps spinning.
Well, we have you here. Let's talk about that. How do you prioritize debt? What should you be paying? Obviously, mortgage comes first, but let's say you have multiple credit cards, you have multiple loans that are out there, and hopefully you don't have an ARM, right? An adjustable rate mortgage.
Yeah, for sure.
How do you prioritize what debt gets paid?
Well, I'm a believer that highest interest debt is what you should pay down first. I understand there's the psychology of things where some people would rather go for the small wins, where you're paying off a small balance where you can shut down that credit card. But for me, I think it's really all about the math. If your goal is knocking down that debt, you want to reduce the amount of interest you pay. You want to reduce the amount of time that you're spending paying down. And really the best way to do that is to focus your energy on that high interest debt, because that's the best way to slow the growth.
All right. Appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.